With CPI just around the corner, Bitcoin is in a very delicate position, currently rejecting from the 30,000 major yearly long resistance. Are we going to see a continuation downwards, or will bullish CPI data push the price upward? Let's go ahead and jump into the charts. Okay guys, welcome back to the channel. Thank you for tuning into today's video. Bitcoin is currently rejecting from the 30,000 major horizontal yearly resistance on the daily time frame. In today's video, we're going to discuss what the implications of CPI could have on the cryptocurrency market, how that's going to affect the short-term price and potential higher time frame directions. We'll discuss higher targets, possibilities of rejections, lower targets, the short-term, technicals, macro, and so much more. So stick around until the end. Now, before we get into it, smash that like button, hit the comment button, and of course, guys, subscribe to the channel if you are new here. We do daily videos for Bitcoin, focusing on the charts, the data, the technicals, the structure, and all the relevant information you need to understand and navigate the charts on a daily basis. No emotion, no hype, no BS, pure, raw statistics and probabilities. You can also find us on Telegram if you want more information. This is going to be the second link down below. You'll get access to charts, updates, videos, analysis, information, educational posts, news events, and so much more. If you're interested in supporting the channel, sign up to Bitget for 15% off your fees and join our VIP channel. We'll get access to two channels, our main channel where we post all of our trades and exclusive updates, and of course, our exclusive group chat where you get access to 4 exclusive chats, including a trading chat, a general chat, a help chat, and of course, extra videos for altcoins. We'll be starting those pretty soon. With our VIP signals, you'll have exact entries, exact targets, and exact stop losses. All of our trades are based on the data, based on the charts, no speculation, no emotion. You can find our entire trading track record right over here. Let's get into the video, guys, starting off with the market data as per usual. Looking at the month, currently April is up 5.22%. So pretty good. Our volume is down 10% for the last 24 hours, sitting around 82 billion. And our liquidations are down around 35%, sitting at 104 million. Now I'm going to go ahead and say this. Looking at the volume and liquidations and looking at the price action, honestly, I would have expected it to be a lot higher. Considering the move we had on Bitcoin, a significant rally to 30,000, I would have expected liquidations to be pushing 150 million. I would have expected volume to be pushing 150 billion. It's quite surprising to see how volume and liquidations are still relatively low in comparison to the kind of move we actually saw in the market. Moving on, guys, we can see our volatility index on the 2-day has dropped to 2.58, and on the 60-day period has dropped to 3.08. Again, if you look at the 30 and 60-day periods, you can see we are starting to plateau and very slightly drop. Again, on the 30-day period, you can see we are plateauing and we're finally starting to drop off. This is not a good sign. This is obviously a bad sign for the market. If we start to see volume drop and volatility drop, we know that overall momentum is falling. If momentum is falling, we know speed, velocity of price action is dropping, and we know that volume is dropping. Therefore, the price trend or the trend is weakening. We generally see this kind of stuff at resistances. We generally see volatility fall, volume fall, momentum fall as we approach high time frame structural resistances, which we have approached, right? We are within the 28 to 30,000 major yearly resistance, which we'll talk about today. And we'll talk about our higher targets and everything in between in today's video, but we are starting to see these things show up and they are standard for these resistances. Moving on from there, guys, the broader markers, the DXY has once again came back down and actually found support. We're currently bouncing on the 102 to 101.8 level. And I do not expect this zone here, the support zone, to be lost until CPI. I think CPI has a potential to crash the DXY below it, or the potential to bounce it quite aggressively. As we know, CPI is a leading indicator for interest rates. It is a descriptive, it is a diagnostic indicator of the inflation rate in the economy. It gives us a tangible reading of inflation. Now we know that inflation, of course, is a negative. It pushes interest rates up because interest rates rise as a consequence to rising inflation to combat inflation. So if interest rates rise, the cost of debt increases, the strength of the dollar generally goes up and asset prices go down. So if we do see inflation come out bearish, okay, meaning inflation has gone up, we are going to see the probabilities for interest rate hikes to rise, and as a consequence, the perceived risk in the market is going to rise, and the DXY should go up as asset prices come down. And the complete opposite will occur if the inflation data comes out bullish. So let's take a quick look at inflation data. I actually posted it in the channel on Telegram here. You can see this is kind of what we're expecting. We can look at the data over here. All of the data is given here. You can go into the channel, take a look before inflation comes out. We'll be posting the exact data in this channel, of course. You can see the forecasts and the previous results here. It's coming out in around 9.5 hours. But if we go down to that post here, this is kind of what we're expecting. If we see the result of the inflation equal to or greater than the previous, we're going to expect a bearish sentiment. And I think we're going to see a slight correction in the markets. If we see the result equal to or less than the forecast, this is going to result in a high time frame bullish confluence. So the short-term direction is going to be a little more unclear just because we've had such an aggressive move upwards within the last few days, and we are still at resistance, but that should facilitate an economic environment where interest rates will continue to move towards a pivot, and the higher time frame should remain bullish and continue bullish, which will result in a high time frame uptrend. If the result is much less than forecast, this is going to be incredibly bullish, and we're most likely going to see a massive positive reaction to charts, and we're going to see the prices rally quite aggressively, but not only just rally aggressively, most likely stay elevated after the rally. So break over that 30,000 and remain over the 30,000. And if we see the results much worse than previous, this is going to be incredibly bearish, and we should see an aggressive correction that could potentially extend into a higher time frame correction. And the reason because of that again is this entire move, and we've been talking about for a very long time, this entire move has been almost developed, particularly this section, right? Ever since the banking collapse, this particular section has been developed on the basis that the economy, interest rates are falling, inflation is falling, and the pivot is eventually coming. The narrative that we're seeing a pivot. And I've been saying ever since all the way back over here, we do not need to see interest rates going negative for the economy to turn around and asset prices to rise. Assets move on perceived risk, not actual risk. All we need to see is the potential for a pivot and the markets will rally. That is what we've seen, okay? So we have that current narrative, okay? Price action is built upon economic, political, and social perspective, whether it be political decision, social perspective, economic policy, okay? And that is what drives macro trend. That is what drives the macro direction of asset classes. The current narrative is pushing the price up. If that narrative shifts, which it very well could shift based on the leading data we get today, we could see a change in the trend. And if we're going to see a change in a trend, it's going to occur while we are at resistance. And that brings us to talk about this chart here, guys. So we'll get into Bitcoin now. Looking at the higher time frame chart, I've gone ahead. I wanted to briefly interrupt today's video to discuss my favorite exchange, Bitget. If you're looking for a safe, honest, reliable, and accurate exchange, look no further than Bitget. You can sign up by the link in the description to support the channel and get access to 3 exclusive perks. That being up to $5,005 in trading rewards, up to 15% discount on your trading fees, and exclusive access to our MegaWhale promotion campaigns that we run every few months. Alongside that, guys, Bitget is a non-KYC exchange, meaning you do not have to KYC. It is completely optional. Bitget also has a protection fund that secures user assets against external hacks and threats in the space. Alongside that, guys, Bitget offers up to 125x leverage on futures with extensive amount of trading pairs and liquidity on the market. I highly recommend signing up to Bitget. It is the exchange I've been using for over a year and a half now, including all of our members. If you're interested in signing up, trading there, and supporting the channel, you can do so with the link in the description. Thanks for listening. And annotated a few little labels on here to make it a little bit more clear. And we talked about this yesterday. And we'll briefly go over the macro today, and then we'll get into a short time frame and discuss the immediate time frame, what we're looking for leading up to CPI, some scalp trades, and all that kind of stuff in a second. But what we've seen is a bullish trend. So we'll start from left side going over to right hand side. We have a macro trend, right? We have a weekly, we have a daily, we have a nearly a monthly trend at the moment. We have a uptrend, a bullish trend. This uptrend was developed through the period of this falling wedge pattern, okay? And we broke out of the falling wedge pattern, breaking over a few things. We broke over the 2-day 50 EMA, which was converging down over here, okay? We broke through the 19,200 POC level, and we broke through a 5-month-long consolidation, which was our falling wedge structure. That was all out of an extension pattern, meaning this falling wedge was an extensionary pattern of the macro downtrend. If we look at the macro downtrend or the bear market, and we look at the angle of this downtrend here, okay, the angle of the downtrend compared to the angle of this downtrend, we have a much steeper downtrend here in comparison to here. What does that suggest? Well, it suggests that bearish strength was being lost. It suggests that bullish strength was rising, and momentum, volatility, volume, all of those leading indicators for the strength of the trend was starting to flip. It was very clear, it was very obvious that a reversal was inbound. We've said the breakout of this structure will take us to 2 primary targets. Number 1, the local top of the falling wedge from breakout point. And number 2, the measured move from the falling wedge to bottom to top to the breakout point, which took us to 28 to 30,000 major resistance. So according to our major macro structures, we have reached those targets. The bullish trend that we are in has completed its measured move. And in fact, I have sold all of my spot bags that I bought at 16,500, 18,000, 19,200, average of 17,200 at 30,000. I will rebuy these bags if CPI data comes in good. The market can find some stability above around 31,000. We'll talk about that another day. But if you have been following me, that is what I have done. Looking at over here, we have a possible trend reversal, right? We are in a macro yearly resistance. We have seen this area act as major support. And as we have said before, guys, these principles don't change based on your emotion. We have to keep them relative. What is the point of having a core principle if you change when you listen to the core principle based on how you feel about the price action? Irrelevant. Strong support becomes strong resistance. Strong resistance becomes strong support. We have seen it, okay? At the moment, we are testing an incredibly strong, yearly long bull market support line. We tested it 3 times in the bull market. On the 3rd time, we broke toward the downside, resulting in a cataclysmic crash of like 30%, I think it was, or even 40% within a very short period. It tells us there's a lot of confluence at this level and a whole lot of resistance at this level, as we have seen, right? We've seen a lot of resistance coming into this range, and we are currently retesting the upper point. So I'll say it once and I'll say it again. Until we break above 30,000 on the monthly chart, and I'm saying monthly chart because according to our macro chart, every single time we break above the prior yearly low of support in the bull run, you can see this instance is 30,000, we need to close that monthly candle to actually get the continued uptrend, okay? We have seen failed monthly candle attempts, okay, which do not result in continuation upwards. We need to see the monthly candle to get the continuation toward the upside. So we do need to see a monthly candle close to have proper confirmation that this current resistance will flip as support. Until then, I'm going to say it again, until then, you do need to be very much aware that the possibility for rejection is there. We'll talk about today, even though it's dwindling. And the rejection is not going to take us to new lows. That's absurd. I've been saying it the entire time. We are in a bullish trend. We are in an uptrend. The uptrend needs to be lost before we think about new lows, and the uptrend will remain intact until we lose this level. But let's take a look from the right. Bullish above 30,000. We're bullish from 20 to 25.2. Obviously, within this range, we're bullish, right? Okay, this is going to be resistance. And we're bearish below 18.3. So we are bullish, we're in an uptrend. We're in a bullish trend above 20,000. We're in a macro bullish trend above 30,000. That's our macro bullish trend above 30,000. And we are in a macro bearish trend, meaning we're expecting new lows below 18.3. Moving on, we can see our angulars or our arrows, our directional biases. When we are at resistance here, we have a directional bias downwards as we are at resistance. When we are above resistance here, we have a directional bias upwards as we are above resistance. The same thing we can look at over here. Above, directional bias upwards, below, directional bias downwards. In this instance here, since this is a major point of support, at this point we have a bullish trend. This bullish trend now we are in, this uptrend that we've been developed and we have developed from the breakout point, is holding as support around this point, meaning we will have lost this bullish trend if we drop below 24,000, and we will have lost the overall potential for a reversal on the macro sub 18k. I hope that makes sense. I hope it explains it very simply. There is no need to overcomplicate it. Look at all the people back here, guys, who are trying to overcomplicate things with so much data, so many charts, all this Elliott wave theory, we're going to 3k, all this chaos. You just look at the charts, analyze it for what it is, take it at face value. It's not about being correct the entire time. It's about putting yourself in alignment with probabilities. And the probabilities were correct in this instance. We saw an exact move. The probabilities in this situation still technically remain. Nothing has really changed. Nothing has really changed. And the one thing that could drive change is going to be CPI. And that is why it is so important. So let's take a look, guys, at the short term, and then we'll wrap up the video. Actually, then we'll do a technical analysis on the daily, and then we'll wrap up the video. Actually, no, we'll start with the daily. Let's do a technical analysis on the daily, get the daily done, get the higher time frames done, and then we'll come back to the smaller time frame. So where can Bitcoin realistically go, guys, if we break above 30,000? What would our next targets be? What are we looking at? Where are we expecting? So I said this already, I think yesterday, and we'll say it again. The highest I think Bitcoin could go within this month before breaking a monthly candle. So obviously we know breaking a monthly candle above 30,000 is going to be confirmation. But I think we could see a move upwards for best case scenario if CPI comes out very good. I think the move upwards could take us to retest this range over here between around 31,500 to 32,300-ish. I think that's going to be another major point of resistance, almost like a massive rounded bottom, massive neckline of resistance before we come back down and potentially explode back upwards. Okay, how deep that dip will come, again, it depends on a lot of factors, hard to say for sure, but we could potentially see that move. So if I'm looking at the bullish targets, if CPI comes out bullish, I'm going to be expecting a rally towards this level. This is going to be a great point for short-term retest on this higher time frame for a potential macro rejection, or again a potential pullback, or even potential confluence for a continuation upwards if we break that level. For the short term, guys, we'll come to it in a second. We do expect a little volatility moving to CPI. Direction is always a little more unclear, but we'll get to that in one moment. So for upper targets, I'd be expecting target number 1 within this range. Assuming we're bullish, I'd be expecting target number 1 within that range we just outlined. Target number 2 is a macro resistance, and the next macro resistance of Bitcoin is sitting around 40,000, right? This is our next macro. It actually sits a little bit lower. It's around 38 to 40,000 when considering the VRPV. This is going to be an equivalent resistance in comparison to the resistance we are currently retesting at around 28 to 30, and again the resistance we retested down over here around 24. So around the same amount of significance. That is going to be our next resistance. Above that, we have an even more important resistance. And this is going to be one of the most important resistances for the bull market. And this is the yearly, well, this is the first local dead cat bounce, of a high of the dead cat bounce. And we take a look at our Bitcoin chart on the macro, particularly these dotted lines. If you look at the prior cycles, the dotted lines represents the horizontal scale of the highest point of the first dead cat bounce after the local top of the bull run, okay? And we can see these dotted lines here. What we also notice is when we break back above a monthly candle of that dotted line, from that point onwards, the volatility in the bull run significantly increases. So if you're looking for that parabolic phase of the bull run, the parabolic phase of the bull run should kick off a monthly candle close above 48. The bull run will start sooner than that. Like we said, we talked about it yesterday. We need to see whatever we talked about it yesterday. Watch the video. I don't want to go into too much today, but this video will go for about 50 minutes if I do. But essentially, we're looking for the day range trend. Essentially, looking for the Ichimoku cloud baseline break, and essentially, we're looking for the monthly candle close of about 30. But for the volatile period of the bull market, for the parabolic phase of the bull run, we're looking for a monthly candle above 48. So 48 is going to be essentially the trigger point for a new all-time high. A break over a monthly candle of 48k will be the confirmation for a new all-time high. Okay, let's get into some technicals really quickly, and then we'll go to the short term so we don't drag this video out too much. There's a few technicals I want to look at, and that is of course going to be our momentum indicators. Momentum indicators are the best indicators, guys. They are the best. Let's take a look. What do you already see? Well, on the daily chart, we're still seeing that bearish divergence play out. Now, we did see one really good thing, and that was we saw the break of this RSI trend line right over here. That was phenomenal. That was a really good thing to see. Like we said already, that daily break on the RSI trend line was going to happen before the price moved up. If you caught that break, you saw that, you were watching the videos, you were paying attention, you would have been able to catch this entire move to 30,000. Okay, exactly as we said in the videos, it did occur. So congratulations on that. However, if we go to higher time frames still, we still do very much see a slight divergence playing out. It is a slight divergence, okay? The higher time frames are definitely looking good, but it is still very much there. And these are things that we do need to pay a little bit of attention. I'd say a little bit of attention just because, again, on the daily chart, on the 3-day chart, it is starting to fade away as we have had that move upwards. But if we break it down to these smaller time frames, such as a 12-hour chart, it is still present. And what we know for sure is short term translates to macro. If you're looking for directional moves, you need to look at the relative short term to see how the trend is developing. And what we're seeing here, guys, is we're still seeing that divergence play out. And this isn't a good sign because, again, that divergence signifies there is still overall weakness in the current trend, as you can see over here. And while that remains, this is not a good indication, okay? Keep that in mind, guys, when you're doing your trading, when you're doing your analysis, when you're looking at the charts. Moving to the smaller time frame, I want to go back and bring up our immediate small time frame chart. Let's just rewind some of this stuff over here. We'll do a 15-minute analysis, a 5-minute analysis. So what we saw over here was a pretty steady uptrending support line. We saw a uptrending support line right over here in the last 20-30 minutes. This uptrending support line broke toward the downside. We saw a pretty significant drop, okay? And we talked about our targets in yesterday's video, you know, what areas we're looking for pullbacks towards, what ranges we're looking for pullbacks towards. And we said in yesterday's video, we saw two gaps in volatility. We saw a gap between 30,000 to 26,000, and we saw a gap between around 29,600 down to around 29,200. These areas are areas of low historical resistance, okay? Or low orders, meaning there's a lot of volatility in these price ranges. Here, we can see a lot of volatility occurs in this price range. Essentially, that means it requires less volume for the price to push aggressively through these ranges, and therefore we're looking for these aggressive dumps in these ranges. These middle areas between are going to be support. So we have support, okay? We have increased volatility, and increased volume, increased speed, increased velocity, which more aggressive a price action occurs. Between that, we have layered support. We have the complete opposite. We have areas of decreased volatility, areas of more orders, areas of which liquidity provides, areas of which the price can bounce, okay? So in the short term, our targets are going to be, like I said yesterday, these levels for pullbacks, okay? Those are the targets. So we start to see this trend develop downwards more, which we are in the short term, and it is starting to pop up again on the 15-minute chart. We can see the price is under our 50 EMA. The price is pushing below these support chunks. It's moving into these low volume ranges. The probability that this trend continues downwards here, whether you like it or not, is actually more likely. So we are starting to see it develop. We are starting to see the bears take over a little bit on the short term, as the bulls were in massive control now for the last 2 days, liquidating heaps and heaps of money, and a lot of late longs. Late longs, not for altcoins, but for Bitcoin, it's getting up around this 30,000. This 30,000 range was a range of which we were looking to sell our spot bags, not buy a spot, looking to offload our longs, not jumping to new Bitcoin longs. So the people doing it reverse will end up just becoming chump change, chump liquidity, but it doesn't matter, okay? What matters is the CPI data. We'll set it again. The short term, the technicals, the structures, everything is completely relevant, but when it comes to economic data, data that can actually move price action, that takes significance any day of the week. It takes the cake. That stuff is significantly more important. So I wouldn't be sitting here and saying, you know what, Whale, I'm going to jump into a massive short right now because we're under the 50 EMA. well, guess what? You're probably going to get wrecked. Not because it's not going to go down, but if the CPI data comes out bullish, then you're wrecked. So the data that we need to understand how the price is going to move in the next 10 hours, the data we need to understand the next day or next 2 days of price action, we don't have available. Not only do we not have available, but we can't predict. It's not public knowledge. It's not public knowledge. We can infer, but why would you trade based on speculation? These are things we have to consider. So wait for the data, then act. Don't jump in the market 10 minutes before the data comes out because it's spiked upwards. Guess what? There's marketing manipulators, there's bots trading, there's people with a lot more money than you, there's hedge funds, there's people get the data early. These people are trying to trap your liquidity. They're trying to take your money. Do not fall for it. Trading is PvP. Your losses are their profits. Your losses are my profits. You're trading against people who have more information and more knowledge and more experience, better emotional control. So when it is volatile, the best thing you can do is to take a step backwards. And these periods, such as CPI, are the most prime examples of times you shouldn't be trading. If you look at your statistical probabilities of winning, they're at basically all-time lows when you're trading news events, unless you have an edge, whether it's scraping data early and that costs a lot of money, requires a lot of skill of coding, or whether it's you know people who get the data early. But whatever it is, you have to be aware of the possibilities. So thanks for watching, guys. Hope you enjoyed. Sign up to the Crypto Academy. We teach you everything you need to know how to trade. And of course, we'll catch you guys in tomorrow's video. Cheers.